Many traders search for the best supply and demand trading strategy or try to understand how professional traders trade. But without understanding the liquidity concept in trading and the structure behind price movements, these strategies often fail. In this video, we will break down a complete guide to market structure, explain how to mark market structure in Forex, and show how liquidity and inducement influence where high probability moves are more likely to begin. Welcome to the ComLucro channel. By the end of this session, you will understand how professional traders read market structure, how liquidity drives price movements, and how inducement creates the conditions for the real move in the market. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Before we talk about order blocks, fair value gaps, or liquidity traps, we need to understand the foundation behind all of these concepts. So, how do we actually determine whether a market is in an uptrend or a downtrend? Markets move through different phases. At times, price trends higher in an uptrend. At other times, it trends lower in a downtrend. And there are also periods of consolidation where price moves sideways and direction is less clear. In this video, we will focus specifically on trending conditions. Let us take an uptrend as an example. During an uptrend, the market does not move straight up. Instead, it moves in a structured way, forming what we call higher highs, usually marked on the chart as HH, and higher lows, usually marked as HL. They are called higher highs because each high is higher than the previous one, and higher lows because each low is also higher than the previous one. In contrast, during a downtrend, price forms lower highs, marked as LH, and lower lows, marked as LL. They are called lower highs because each high is lower than the previous one, and lower lows because each low is also lower than the previous one. In an uptrend structure, each time price breaks the previous high and creates a new higher high, this movement is referred to as a break of structure, commonly abbreviated as BOS. Of course, markets do not remain in an uptrend forever. At some point, the trend begins to change. This shift occurs when the previous lows are broken, leading to the formation of lower lows. Before this break, price was forming higher lows. Once those levels are broken, they turn into lower lows. This break of the previous lows during an uptrend is known as a change of character, often abbreviated as CHoCH. It is called a change of character because the market shifts from an uptrend structure to a downtrend structure, and the cycle continues. During a downtrend, price forms lower highs and lower lows. Each time a previous low is broken, that move is considered a break of structure, or BOS. Later, if price breaks the previous highs and forms higher highs during a downtrend, that move is again referred to as a change of character, or CHoCH. Now that we have seen a simplified overview of how break of structure and change of character describe shifts in market direction, let us take a deeper look at how market structure actually develops on a chart, and how major highs and lows define the framework behind price movement. The behavior of market movements can fundamentally be attributed to two main factors that consistently dictate the direction of prices: trends, which encompass both uptrends and downtrends, and the consolidation phase, characterized by choppy or ranging markets. Picture this as a perpetual cycle, where prices continuously oscillate between downtrends, uptrends, and consolidation periods, each gathering liquidity and institutional orders. Typically, prices need to consolidate following uptrends and downtrends. A vital initial step when analyzing your charts is determining whether the market is currently experiencing an uptrend, a downtrend, or is in a consolidation phase. To build a robust understanding, let's start with a straightforward overview of market structures before exploring the intricate details of advanced market dynamics. Consider an idealized version of a market structure reflecting a perfect uptrend. I term this as ideal because it's rare to encounter an uptrend in real markets that follows this pattern precisely. Markets don't usually move with such predictability. Nevertheless, to enhance our understanding of uptrends, let's examine this ideal model before shifting our focus to the more realistic uptrend structures that are more commonly observed. In a typical uptrend, prices will consistently create higher highs and higher lows. The pattern generally sees prices surpassing previous highs while sustaining the lows. An uptrend concludes when there is a break below one of the significant lows. To preserve the continuity of an uptrend, it's essential that these major lows remain unbroken. Additionally, when a price exceeds a major high, it results in a structural break and forms a demand zone, indicative of a break of structure, or BOS. Accurately identifying major highs and lows is crucial because it allows us to recognize signals for potential trend reversals or continuations. Without correctly pinpointing these key points, traders are at risk of misinterpreting market signals and potentially entering trades on the wrong side of the market. These principles are equally applicable in bearish scenarios. During downtrends, prices consistently form a sequence of lower lows and lower highs. In such scenarios, prices tend to break below previous lows while still respecting the previous highs. Let's explore the details of a realistic market structure, focusing on the more commonly observed uptrend patterns in the market. Consider a scenario where the price surpasses previous highs, breaking upward. At this juncture, a key question emerges. How do we pinpoint valid major highs and lows? To address this, let's examine the left side of the market structure. It is evident that the price underwent an upward trajectory until it began to retrace. The peak reached before this retracement is deemed the major high. Conversely, the lowest point during the bullish wave that triggered this upward movement and led to a break of structure and a new high is recognized as the major low. These 2 points are the critical external structures of the market, and any structure that develops between them is considered an internal structure. When the price surpasses the major high, marking a break of structure, BOS, it indicates a continuation of the upward trend. On the other hand, if the price drops below the major low, this should be interpreted as a signal of a trend reversal. The internal price actions within these external structures are secondary, provided the price stays above the most recent major low. Maintaining this condition signals that the market remains in a bullish phase. You might wonder why this low at the extreme is treated as the major low. The reason is that it represents the ultimate low point before the price starts its upward trajectory. This particular point is essential as it's the pivotal low that catalyzed the upward movement and the subsequent break of structure. Now, let's transition to the bearish scenario, which mirrors the bullish scenario. The bearish wave begins, leading to a structural break. We also identify a major low, marking the lowest point reached after the structural break. These 2 points, a major high and low, act as our external structures, while all structures developed between them are viewed as internal. Should the price break these major lows downward, it signals a continuation of the trend as illustrated here. Conversely, if the price climbs above the major high, this would be indicative of a potential trend reversal. In simpler terms, the internal price actions within these external boundaries are secondary, as long as the price remains below the most recent major high, signaling a bearish market. As the price retraces upward, it establishes a series of internal highs and lows within our defined trading range, yet it eventually ascends, breaking the recent major low downward. This internal high, situated at the extreme, is now recognized as the new major high because it marks the highest point reached before the price initiated a strong bearish push, resulting in another structural break. Following this, the price undergoes another retracement, forming another major low. After establishing various internal structures, the price sustains its downward momentum, creating a sequence of lower lows and lower highs. Now, let's explore another vital concept in market structure analysis, the break of structure, BOS. You might have come across this term in various trading tutorials, market structure videos, and handbooks. Typically, in a bullish scenario, a BOS is often simply described as a situation where the price surpasses a previous high. However, to accurately utilize this concept, specific criteria and rules need to be adhered to in order to confirm a valid break of structure. Let's dive into these key points and rules. A valid break of structure is confirmed when the price not only breaks, but also closes above the most recent higher high with the candle's body. This validation holds even if the price retraces downwards immediately after the break. In such instances, the market establishes a new major high and major low, defining a new trading range. Should the price then break this newly established major low heading downwards, it suggests a potential trend reversal, indicating a shift from a bullish to a bearish stance, a change of character, or CHoCH. Continuing our exploration, if the price breaks the previous higher high with a long wick or shadow, and the body of the candle closes below the high's range, and if the subsequent candle's wick does not exceed the first candle's wick, this does not qualify as a valid break of structure. In this instance, the resulting low is treated as an internal structure within the trading range. For a reliable indication of a trend reversal or a valid change of character, we need to observe the price breaking below the significant low at the extreme, rather than merely breaking above an internal high. Now let's consider a different scenario. If the price surpasses the recent higher high with a wick, and the body of the first candle closes below the high's range, but the subsequent candle's wick exceeds the first candle's wick, we then recognize this as a valid bullish break of structure. Here, a new major high and a new major low are established, outlining our updated trading range. The internal price action within this defined range is less significant, provided the price remains above our newly established major low, which signifies a bullish market. If the price later breaks this newly formed low downward, it then acts as a clear indicator of a trend reversal or a valid change of character. Transitioning to the bearish scenario, which mirrors the bullish one. For a bearish market structure to confirm a valid break of structure, the price must break and close below the most recent lower low with the candle's body. If the price breaks the newly created major high upwards, this signals a trend reversal, suggesting that control has shifted from sellers to buyers. Conversely, if the price breaks the recent lower low with a long shadow or wick and the candle's body closes above its range without the subsequent candle's shadow exceeding the first candle's wick, this is not considered a valid break of structure. To confirm a genuine break of structure, the price must close below the low's range with the candle's body. Moreover, if the subsequent candle's wick surpasses the first candle's wick and closes above the low's range, this then qualifies as a valid break of structure. We must also update our major low and major high accordingly. As long as the price stays below our newly established major high, the market is considered bearish. Only if the price breaks this new high upward do we acknowledge it as a valid signal for a trend reversal or a major change in character. Having explored various types and scenarios of break of structure patterns, and now possessing a solid understanding of what constitutes a valid BOS, let's delve into another key aspect of market structure mapping, the change of character, or CHoCH. The first step in identifying a valid change of character involves determining the general market direction, whether it's an uptrend or downtrend. Next, you need to highlight the valid breaks of structure on your price chart. In the bullish scenario, consider how the price forms a series of valid breaks of structure. The low and high that define these breaks are our major structures associated with the first valid bullish BOS. As previously noted, any price action that occurs between these two structures is deemed internal. Change of character patterns can be categorized into two types, minor and major. For instance, each time the price breaks any internal low, it signals a minor change of character. It's crucial to understand that a minor change of character alone should not be taken as an indication of a complete market structure shift. Here, we encounter a common pitfall in the market. Many novice traders who have not properly identified the market structure often misinterpret a minor change of character as a signal for a reversal in market direction. Believing that the bullish phase has ended, they might think it's an ideal time to enter a short position. Typically, they place their stop loss just above the internal high. However, contrary to their expectations, after a brief retracement, the price climbs again and continues its upward trajectory. This often results in hitting the stop loss of traders who took short positions. They frequently fail to understand why their stop loss was triggered by the price and tend to repeat this mistake. What they miss is a crucial detail. The price did not break the major low that would confirm a shift in market structure. They should not enter a short position until the price breaks the last major low to the downside. Their perceived change of character was invalid, and the price was merely in its retracement phase before resuming its primary upward direction. To capture a valid market structure shift signal, traders should patiently wait for the price to establish a major change of character by breaking and closing below the last major low that initiated the upward movement leading to the bullish break of structure. Furthermore, it's essential to remember that in a bullish scenario, a change of character pattern is only considered valid if the price breaks and closes below the last major low using the body of the candle. If the price breaks the most recent high with a long wick or shadow and then closes within the high's range, the change of character is deemed invalid and cannot be seen as a decisive market structure shift. This principle is mirrored in bearish scenarios. Understanding market structure tells us the direction of the market and helps us identify when trends are continuing or potentially reversing. However, knowing the direction alone is not enough to execute trades with precision. We also need to understand where price is currently trading within the overall range. This is where the concept of discount and premium becomes important. What is discount and premium in the ICT method, and why does it matter for how price is analyzed and traded within a range? When analyzing price within the ICT framework, one important concept quickly becomes clear. Price does not offer the same opportunity at all levels of a range, and context always matters. This observation naturally leads us to the idea of discount and premium as a way to frame price location more effectively. To understand how these zones work in practice, we must first understand the idea of a range. A range is simply the space between a swing low and a swing high, or between a swing high and a swing low. This range defines the boundaries within which price is currently moving. Let us take the example of a range that forms from a swing low to a swing high. To define the premium and discount zones, we divide this range into two equal parts. The upper half of the range is always called the premium zone, while the lower half of the range is always called the discount zone. So when using the Fibonacci retracement to define discount and premium zones, it is essential to draw it in the correct direction. In a bullish scenario, where the range is measured from a swing low to a swing high, the Fibonacci should be drawn with the 0 level placed at the swing high and the 1 level placed at the swing low. When we look for long trade opportunities, we want price to trade in the discount zone, assuming there are other elements supporting the trade idea. The deeper price trades into the discount zone, the greater the potential risk-reward ratio. This is especially true when the stop loss is placed below the swing low and the target is set near the swing high. For downward price movements, we measure the range from a swing high to a swing low. So in bearish scenarios, the Fibonacci retracement should be drawn in the opposite direction. The 0 level is placed at the swing low, and the 1 level is placed at the swing high. In this case, we want to look for short trade opportunities in the premium zone. The higher price trades into the premium zone, the better the potential risk-reward ratio, assuming the stop loss is placed above the swing high and the target is set near the swing low. This concept of discount and premium is very simple, but it is essential to keep it in mind at all times when analyzing price. It provides a clear framework for evaluating where price is located within a range, and helps define where higher probability trade opportunities are more likely to form, especially when combined with proper structure and confirmation. However, even when traders correctly understand market structure and where price is positioned within the range, many still fall into traps created by the market. Price does not always move directly from a premium or discount level into the expected direction. Very often, the market first creates liquidity by tempting traders into early entries before the real move begins. This behavior is known as inducement. Traders, do you know what inducement really is? Inducements are specific market setups designed to tempt traders into entering positions, often in the wrong direction, so smart money can collect liquidity. In simple terms, an inducement is a trap that leads traders to enter the market in the wrong direction before the real move begins. Because smart money needs liquidity, they often induce traders into early breakouts, fake reversals, or misleading pullbacks. Traders may see order blocks that look clean, but are not the real ones, FVG fills that appear to be valid entries, or equal highs and lows that look tradable. Then price suddenly reverses, sweeps their stops, and moves in the intended direction. Understanding inducement is important because it helps you avoid entering too early at fake levels or liquidity traps. Instead, you learn to wait for the real point of interest, which can significantly improve your win rate. To understand why inducement appears in the market, we first need to understand how liquidity works. Imagine that large financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To execute these large positions, they require a significant number of sellers and corresponding sell orders in the market. Without available sellers, no transactions can take place. Because of this, smart money often needs to trigger the stop-loss orders already present in the market in order to execute their buy or sell positions. This is why the market sometimes creates movements that make traders believe they clearly understand what price is doing. This situation can create an illusion for retail traders, making them believe they are trading on the correct side of the market. However, instead of continuing in that direction, price often moves toward their stop-loss levels. After triggering those stops, the market then resumes its intended direction. That is why identifying liquidity on the chart is essential for traders who want to understand how price truly moves. And this is exactly where the concept of inducement comes into play. At its core, inducement means creating liquidity before the real move. It is the final liquidity created to fuel the true move, and it can appear in different forms: structural inducement, liquidity-based inducement, and time-based inducement. Let's begin with structural inducement. Among all types, structural inducement is the most important because it appears directly inside market structure and forms patterns that traders see every day. Structural inducement occurs when price creates a false structure shift, such as a fake CHoCH or a misleading BOS, which encourages traders to enter early or in the wrong direction. In this example, price is trending higher and continues printing bullish breaks of structure to the upside. However, when we focus on the most recent break of structure, it initially appears completely valid. Price breaks and closes above the swing high. Naturally, this leads traders to expect buy setups at the demand zone or order block that cause that break. Then the outcome becomes clear. You enter the buy, and price quickly takes you out. This is exactly how structural inducement traps the majority of traders. The reason becomes clearer when we look deeper. This so-called BOS was never a real break in the first place. The entire move was driven by resting buy orders sitting below, inside the discount zone of the main bullish leg. If you draw your Fibonacci tool from the swing high down to the swing low, you will notice that price did not even retrace into the 38.2% level, let alone the 50% level of the previous impulse. This is critical. For us at ComLucro, a retracement that does not reach at least the 38.2% level cannot be considered a valid retracement. And even when price retraces only to the 38.2% level, these very shallow pullbacks tend to create inducement and liquidity hunts rather than clean entries. Because of that, traders must be cautious with shallow retracements. The ideal scenario in a bullish trend is to wait for price to retrace into the 50% level or deeper, where price enters the discount zone. This is where real institutional buying is more likely to occur, and where you avoid becoming liquidity for inducement moves. To help identify these deeper retracement areas more precisely, traders within the ICT framework often use a concept known as optimal trade entry. Instead of entering during shallow pullbacks that frequently lead to inducement traps, this model focuses on waiting for price to retrace deeper into the range, where institutional participation is more likely to appear. By waiting for price to move into these deeper discount areas, traders can avoid becoming liquidity for early entries and instead align themselves with the conditions where the real continuation move is more likely to begin. Let us take a quick look at how this concept works in practice. OTE stands for optimal trade entry. It refers to a specific Fibonacci retracement zone that aligns with discount for long trade entries and with premium for short trade entries. The idea behind OTE is to refine entry timing by focusing on areas where price is considered optimally priced within a range. This specific Fibonacci retracement zone runs from the 0.618 level to the 0.786 level. The midpoint of this zone, which is the 0.702 level, is also highlighted. In this illustration, you can see an example of an OTE for a long trade. Notice how this zone falls entirely within the discount zone. It is important to observe how price action reacts to all three levels of the OTE, with particular attention to the 0.702 retracement level. In the next illustration, you can see an OTE for a short trade. In this case, the zone falls within the premium zone. The same principle applies here. It's important to observe how price interacts with each of the three levels of the OTE, especially the midpoint retracement level, just as we do when analyzing an OTE for a long trade. Let us now look at a practical example of how the OTE works on a real price chart. In this example, you can see the 4-hour chart of Euro-USD. An important swing high and swing low have already been identified. From this range, we can mark out the discount and premium zones. Recall that a range is simply the distance between a swing high and a swing low. We can then plot the OTE for this same range. Notice how the OTE falls into the premium zone in this example. If price returns to this area, the focus is on observing how price reacts to each of the three levels that make up the OTE zone. As price moves forward, we can see a reaction at the 0.618 level of the OTE. While this level can be used as an entry, it is important to remember that the higher price trades into the premium zone, the greater the potential risk-reward ratio. In the next chart, price initially reacts slightly to the downside, then returns back into the OTE zone. Price closes above the midpoint, but remains below the 0.786 level. On the very next candle, the market drops aggressively. Within one more candle, price reaches the swing low target. If a short trade was executed at the midpoint of the OTE with a stop loss placed above the swing high and a target set at the swing low, this trade would have delivered a 2.4 risk-reward ratio. In the final image of this sequence, price continues moving lower after the initial target is reached. This highlights an important point. While a 2.4 risk-reward ratio is solid, there was additional downside potential that could have been captured depending on trade management. Let us now look at a long trade example using the OTE. In this case, price has just formed a swing high. We first draw the discount and premium zones, and then plot the OTE using the range defined on the chart. In the next chart, price returns into the OTE within the discount zone and reacts at the lowest level of the zone. Price touches this level without closing below it, and shortly after, price begins to move higher in the direction of the previous swing high, which represents buy-side liquidity. As we can see, deeper retracements into the discount zone often create the conditions where higher probability continuation moves can develop. These areas tend to appear after liquidity has already been collected from traders who entered too early during inducement. Understanding this relationship helps you avoid fake structure breaks, recognize liquidity-driven pullbacks, and stay aligned with the real direction of the market. Now let's move on to the second type of inducement. Liquidity-based inducement is the most common form of inducement you will see in the market. It occurs when price intentionally creates a new high, a new low, or a small order block or breaker that looks very clean, with the purpose of attracting traders, collecting their liquidity, and then delivering the real move. And this happens every single day across all markets and time frames. The main objective behind this behavior is to generate stop losses that smart money can use as fuel. By pulling retail traders to the wrong side of the market, their stops can be collected right before the true move begins. That is why you often see a small high form before price drops, a small low form before price rallies, a fake breakout before a reversal, or equal highs and lows getting swept by just a few pips. These are not coincidences. This is smart money deliberately engineering liquidity. To understand this behavior even more clearly, we need to look at where liquidity actually sits on the chart. This brings us to the concept of static liquidity. Static liquidity refers to specific zones in the market where a large pool of orders is resting, such as stop losses, buy stops, and sell stops. When a trader gets stopped out of a position, the market absorbs the orders associated with that stop loss. Recognizing a liquidity sweep before price reaches our point of interest is therefore very important. These sweeps often confirm the strength of a supply or demand area, and many traders use them as a confirmation factor. The idea is simple. The market requires liquidity in order to generate momentum. If price does not sweep liquidity before reaching a key level, that level often becomes the liquidity needed to fuel the next move. Static liquidity can appear in several common areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and inside order blocks. It can also form around support and resistance levels, Fibonacci retracement levels, and near important candle bodies or wicks. Because these zones are widely recognized by traders, they tend to attract large numbers of stop losses and pending orders. For this reason, price often moves toward them to absorb liquidity before continuing its real move. Now you might wonder why price often forms an inducement right before tapping into a fair value gap. The reason is simple. If price moves directly into an FVG without inducement first, there is no liquidity. Smart money has no fuel to reverse the market. The reaction from the FVG becomes weak, and the entire setup can fail due to a lack of sellers to buy from. In simple terms, inducement is what creates the liquidity that fuels the move out of the fair value gap. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.